Hey, what's happening, guys? Dan Darrow here with another Options to Play video update. Today I'm going to talk about basically what I look for when I am thinking about putting on a calendar spread. Okay, um, that strategy I feel like particularly interesting in like the current trading tape because so many stocks are seeing such huge levels of near-term implied volatility. I mean, we're moving like 10% in the S&P on a day. Stocks are moving like 10, 15, 20% on a given day. So just incredible, massive levels of implied volatility on really like close expiration contracts, right? Um, now, I'm going to assume you know what a calendar spread is because this is not going to go over exactly what a calendar spread is. But what I really wanted to talk about was, I guess, what I look for and then kind of how I design it. Okay, and the first thing I am looking at is I want to see high implied volatility on short-term options, which I mean, check mark, right? I mean, a lot of contracts right now have very high relative implied volatility. So that's the first thing. The second thing, I want to see those high implied volatility contracts basically not go through a catalyst, right? So I don't really want to like see like that high implied volatility go through an earnings report because a catalyst means that a big move is possible. Yes, a big move is still possible even without the catalyst, especially in this tape, but I just don't want the possibility of that, huge catalyst on top of already like a volatile tape. So I want high implied volatility, but no major catalyst, right? Now, one thing that I want and not always getting it right now because so many things have gotten hit so hard is that I want a stock that's at like a longer term level of support. Like, so this is kind of more current right now. So I want something that's at a longer term level of support. I thought Starbucks was interesting because you can see that the stock, right, rolling over into like a really big area of support. So this is a multi-year level of support. So a level that it's basically demonstrated 2015, 2016, 17, and 18 that there's numerous amounts of buying interest in this area, right? So technically, the stock obviously has fallen a long way really quick, but it's coming into like a major demand level for multiple years, right? So like that's one of the good technical things. Now, when I'm looking at the contracts I want to target, right? I don't mind erroring on the side of being a little bit further out of the money because like the main goal of the calendar strategy is that you want the short side of the spread to expire worthless, right? So I wouldn't mind going a little bit further out of the money than I normally would, just because I want a little bit of like a buffer zone. If it does bounce, I don't want that short side of the strategy to be in the money, right? So for me, right now, in this environment, like the spreads, like the strategies, I'm looking possibly for like a 40 to 50% retracement of the recent moves. That's kind of like my ballpark. 50% being like the top end, 40% being, I guess, like more of like the what I think is possibly like achievable end. So for most of these stocks, like when I'm putting like upside targets, they're kind of in like that 40 to 50% retracement zone, right? So if the stock dropped from 90 down to 50, $40 drop, just roughly, then basically what my target would be something in like the 70 range, right? So like a 40 to 50% retracement from the move from 90 down to 50. Okay, so like those are kind of like the ballparks. What I'm using for like technicals, also like my targets, right? Um, Now, Starbucks just one of like many examples, but I feel like it's definitely an interesting strategy. I've talked about it a lot over the last 2 weeks. We talked about it during last night's option session, and I think it's like one of the strategies that probably really worth digging into if you're not really familiar with it, because I find that it's really helpful in this type of environment where the near-term implied volatility is just through the roof, because you can kind of offset a longer term position with those expensive shorter term contracts, right? So offset the price of it, or offset some of the price of it, because you're not going to be able to do all of it. Um, But that's kind of how I go about it. That's kind of how I design it, and my targets are. All right. So if you like these videos and you're looking for more information on options education or more information on possible option trade ideas, please follow up with the link in the description of the video for more information on options applied. All right. Have a great night, and I will talk to you guys all tomorrow.